All right, Shannon, in terms of where we go from here, Mike Wilson says a more aggressive Fed on tapering sets the stage for both fire and ice. Quote, the magnitude of the ongoing correction should be determined by Q3 earnings and retail's commitment to buying the dip. Steve Weiss talked about both of those. Remember, fire, 10% correction. Ice, maybe 25 or 20% is what Mike Wilson's been talking about. UBS, quote, equity market sentiment was hurt by a combination of worries over growth, central bank policy, fast rising yields, and the U.S. fiscal impasse. We believe that such concerns are overdone. We expect the rally to resume. What do you think? Are we going for fire and ice? Or are we going for a resumption of the rally in what is traditionally an ominous month for stocks, that being October?
Well, not to beat a dead horse, but many of us on this show over the last couple of months have talked about these rolling corrections, and Joe's been, one of those vocal advocates of that thesis. And I think that that's what's going to continue. So I see something in between. I do think that we are experiencing, this diminishing concern about Delta. I think that that's leading folks back to the epicenter stocks, some of the more cyclical stocks. But, based on the market, the way that the indexes are constructed, it's going to be very difficult for the market to rally from here with tech under so much pressure. So I do think we need to see some alleviation on the pressure and yields, at least in the short term. It's all about the velocity, as we've talked about. And I think that there could be corrections that are upwards of 15, 16, 17%. Obviously, we've already seen that here in Facebook, and we could see that in other sectors and industries as well. But the undercurrent of economic growth should be maintained. And if we're talking about a 2% 10-year, that really shouldn't put any of us to be particularly concerned about the relative opportunity for these companies going forward. That's not a huge debt burden. And so I think we're not seeing it, in the debt market. We're probably not going to continue to see any support in the debt market for a massive correction in equities. But there could be, in certain sectors and industries, an opportunity over the next 6 to 8 weeks. And I think that investors should be very careful to be aware of what's happening and think about, in an environment where we're going to have continued low rates over the next couple of years, because they will be historically low, you could position your portfolio now to enjoy some of that this low growth, low interest rate environment that's going to persist.
Joe Kramer today, I don't think earnings are going to be nearly as bad as the stock market thinks. What do you think? I mean, we have had some negative pre-announcements. I think, you're looking at tough comps to match up against. If you look at catalysts to lift stocks, or at least keep them from suffering the ice part of Mike Wilson's equation, they better not be horrible.
Yeah, so Q2 EPS year-on-year growth was around 88%. The expectation right now is for about 27%. Listen, the market, Scott, it's in the most tenuous position that it's been in, arguably, since the onset of the pandemic in the Q1 of 2020. As it relates to earnings themselves, I think you're going to have to hear some comfort and some clarity from corporations regarding two very distinct variables in the market right now, one of which is, what's the corporate tax rate going to be? If we have certainty on that, there'll be some guidance that's distributed. I also think that oil prices are going to be a significant factor, and a factor in the guidance, not so much in providing clarity, but really clouding the vision looking forward. We've got a little bit of an issue here. It's represented in the form of a stagflation environment, and it's really based upon seeing natural gas prices and oil prices continuing to rise. What happened today with OPEC Plus is not a bearish contributor to the price of oil. In fact, it's disappointing in terms of the amount of supply that's going to be added to the market. We wanted twice as much as we're actually getting from OPEC Plus. So I think oil right now is one of the leading indicators for the consumer and corporations as we look forward here. And I think it's very difficult and complicated to understand what path that's going to take.